Welcome back to my channel Decode Strategies, your one-stop destination for analyzing and evaluating various strategies. In today's video, we are going to take a deep dive into gold as an investment option. We will evaluate various strategies that you can use when investing in gold, and we'll also look at the historical returns to give you a clear picture of its potential. Whether you are new to investing or looking to refine your approach, we've got valuable insights coming your way. So be sure to watch the video until the end to get the most out of it. Before deep diving into the gold ETFs, let's first look into various options that are available for investing in gold, along with a short overview of what they are. First up, we have physical gold. This includes jewelry, gold bars, and gold coins. Many people love the idea of holding gold in their hands as it's a tangible asset, and investors have always appreciated its liquidity as it can be easily bought or sold. Also, gold is always considered as a safe haven during the market volatility. However, keep in mind that physical gold is prone to risk like theft, and to secure it, you would need to invest on the storage facilities like a bank locker. Also, there will be some additional costs involved during the purchase, like making charges, stone cost, wastage, and GST. Next in the list, we have sovereign gold bonds. These are government securities or bonds that allow you to invest in gold without holding the physical gold. Along with gold price appreciation, these bonds offer additional interest payments of 2.5% per year and are a great way to gain exposure to gold while benefiting from the security of government backing. However, keep in mind that the tenure or maturity of these bonds is 8 years, but there are options to exit the scheme in the 5th, 6th, and 7th year. Let's now discuss about digital gold. This option allows you to invest in gold digitally and is available in popular platforms like Paytm, PhonePe, Google Pay, etc. Investors can purchase 24 karat 99.99% pure gold with a very minimal amount that is starting from as little as 1 rupee. The purchased digital gold is backed by actual physical gold, which is stored on your behalf in the bank grade secure vaults. However, when you buy this digital gold, a 3% GST is charged, and when you sell it for profit, then a LTCG tax of 12.5% is applicable if your holding period is 12 months and above. Another option is gold mutual funds. These funds invest primarily in gold ETF or equity stocks of companies engaged in gold mining or sometimes in physical gold. They provide diversification and are managed by professionals. Here are some of the popular gold mutual funds that are available in the market. The last option in our list is the gold ETFs, and this is the option that we are going to evaluate in this video. So this gold ETFs, also known as exchange traded funds, is a popular investment option that allows individuals to gain exposure to gold without the need to physically buy and store the metal. They track the price of the gold, making it easy for investors to buy and sell units on stock exchanges just like stocks. With benefits like liquidity, lower costs compared to the traditional gold purchases, and ease of trading, gold ETFs have become an attractive choice for both seasoned investors and newcomers. Whether you're looking to preserve wealth or capitalize on price movements, gold ETFs offer a straightforward way to tap into the gold market. Let's now look at some of the popular gold ETFs that are currently available in the market. And out of all these, the Gold Bees by Nippon India Mutual Fund is India's largest gold ETF. Let's now discuss one of the important aspects, which is taxation of gold ETFs. So, effective from July 2024, the long term capital gain tax rate stands at 12.5% without indexation. And to qualify for the LTCG, your holding period should be more than 12 months. Coming to the short term capital gain, if you sell your holding within 12 months of purchase date, then the gains are taxed as STCG and are added to your income. So the tax rate is based on your respective income tax slab. Now that we have covered the basics of gold ETFs, let's take a closer look at some of the investment approaches like SIP, step up SIP, SIP plus lump sum, and step up SIP plus lump sum. For lump sum investments, we'll take help of one moving average indicator which will tell us the right time to do the lump sum. By going through each of these approaches, we will discover the true potential of gold ETFs, and this will also help you set reasonable expectations in terms of returns. So, without wasting any time, let's get started. Here are the basic rules that we'll follow for all the four investment methods. Let's first start examining the SIP returns starting from different years, that is, beginning with 2014 and all the way to 2024. Here, I've considered 3000 as the SIP amount. So, for someone who started the SIP in 2014 and has continued to do it till date, the annual returns stand at 9.6%. Similarly, if someone has started the SIP in 2015 and has continued to do it till today, you will be getting an annual return of 10.1% on your investment. Now, let's quickly do the same for years 2016 up till 2024. In this approach, you gradually increase your investment amount every year. You can start with a smaller amount, and stepping up over time, you can build a substantial corpus without putting too much strain on your budget. For someone who started doing step up SIP in 2014 with an amount of 3000 and has increased the investment amount by 10% every year, the annual returns stand at 8.24%, provided you continue to do it till date. Now, let's quickly do the same for years 2014 up until 2024. With this strategy, you invest a fixed amount regularly through SIPs while also making occasional larger investments when you have extra funds. This method allows you to take advantage of market fluctuations by timing your lump sum investments for potentially higher returns, while the SIP ensures consistent growth over time. It's a flexible way to build your portfolio and maximize your investment potential. For the lump sum investments, we will use one moving average indicator and we will wait for the price to take support on this indicator. Please do remember that we will not do a one-time lump sum investment. Instead, we will divide the lump sum amount into smaller chunks and invest them over a period of time. I've opened the Gold Bees ETF chart, and to do this, all you need to do is search with the term Gold Bees and the chart gets added. Let's change the time frame from daily to monthly. Now let's add the indicator, search for moving average and select this moving average simple option. By default, SMA with a length of 9 gets added. Let's now change it from 9 to 25. So the idea here is that whenever the price of gold Bees ETF touches the moving average indicator, we invest some additional amount. To time our entry properly, every day you can place a limit order with an amount that is equal to the moving average price. For safe side, you can increase the limit order price by 0.5. For example, if the SMA price on a given day is 53.4, you will place a limit order for 53.9 rupees. If you look at the charts, one thing that you might have noticed is sometimes the price goes below the moving average indicator. But we will make sure that we will do the lump sum investment when it touches the indicator. If you want, you can continue the lump sum investment while the price is below the moving average indicator, as this will ensure that you are buying the ETF at a much more lower price. Now, a question may arise like how much should be the lump sum amount? My preferred way of doing this is 1 is to 3 ratio. That is, if my SIP amount is 3000, then my lump sum amount is 9000. Let's quickly look at the returns by assuming that we've started following this approach from 2014 and we are continuing it till date. Similarly, we will look into the returns for subsequent years up until 2024. In In this approach, we will combine the step-up SIP, that is increasing amounts every year by 10%, and the lump sum approach. The ratio for SIP and lump sum remains the same, that is 1:3, but please do remember that the lump sum amounts also keep increasing every year with respect to that year's step-up SIP amount. Alright, let's quickly look at the returns for this approach. To wrap up this video, remember that each gold investment option has its own advantages and considerations. Your choice should align with your financial goals, risk tolerance, and investment strategy.